Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I am Arjun Patsati. And in Let's Talk Bonds, I take you through all the fixed income options available for investors in prevailing market conditions and where to best position the portfolios in the market to get the best returns given a level of risk. And in today's topic, I'm going to talk about the reinvestment risk. What is reinvestment risk? Reinvestment risk is supposing you have invested in a bond or an FD, and the FD or the bond has matured. You have money with you and you want to invest. Now, supposing you're invested in an FD or a bond at, say, 7%, and today the same bond or FD is offering 6%, then you have a higher reinvestment risk. And if the same bond or FD is offering 8%, then your positive, your reinvestment risk is lower because you have invested in a bond or FD, and you have the maturity proceeds. You are investing at higher yields or higher interest rates. And today, and with rates rising across, and with RBI too rising rates, and with rates rising very sharply, interest rates rising very sharply, you have a situation where your reinvestment risk is low. That means when supposing you invest in a bond that is maturing in 1 or 2 years, you will find that after 1 or 2 years, you will actually be reinvesting at same yields or higher yields. And so given this, then given that in the at least in the next uh, foreseeable future, rates are going to be high, and RBI is going to hike rates further. So are many other central banks globally, with a lot of risk aversion and also funds in the system which are becoming tighter. The short-term rates are going to be high and are likely to trend further higher. So in this kind of a scenario, your reinvestment risk is low, as I mentioned. And so you're better off staying shorter, that is, investing in shorter maturity bonds rather than longer maturity bonds, even though there could be those who will tell you that because of higher short-term rates, there could be deflation or degrowth, and her longer maturity bond yields will fall sharply. But that's still very uncertain because inflation expectations are still very high. And these are not times when one should actually look at the past because these are unprecedented times. Too many uncertainties surrounding everywhere. And with all this, and especially with many government bonds in the crisis situation in the developed world, the risk is very, very high in investing for too long a maturity period. So it's better to stay short, invest in 1 or 2 year, maximum 3 year kind of bond. And then when it comes to maturity, you can look to reinvest with a much clearer picture and at very reasonable levels of returns rather than taking a high reinvestment risk. Rates are still to go up. So coming to what are the options available to you now? Clearly, the yields have gone up. So 10-year GSEC yield is at 739 levels. 10-year Bharat bond ETF yield is at 769 levels. 3-year Bharat bond yield is at closer to 7.45% levels, which is a reasonable good return on the bond. And with 3-year GSEC is around 7.12% levels. You have on the private placement side, you have Northern Capital that is issuing 2-year bond at 8.95%. Hero Energy issuing 3-year bond at 9.05%. Toyota Financial Services 3-year bond at 7.55%. Trust Capital issuing 4-year bond at 8.95%. A Mass Financial is showing 60-year bond at 10.7%. You had Tata Power Renewable is showing 7-year bond at 7.9%. HDFC Credila is showing 10-year bond at 7.85%. IRE, in Indian Renewable Development Agency, is showing 10-year bond at 7.85%. Mahindra Financial Services showing 10-year bond at 8%. Axis Finance showing 10-year bond at 8.07%. Shriram Housing is showing 15-year bond at 8.6%. And Cholamandalam Investments is showing perpetual at 9.15%. So you are finding a lot of 10-year plus issuances. All these are actually going straight to pension funds or insurance companies and not to trading books, because the levels are very, very fine. And except for Chola Perpetual, that's also could be invested in by other smaller investors as well. There are a lot of 2-year bond issuances as companies look to shore up on liquidity, or in case rates can rise further. So you would see in this month a lot of bond issuers coming to the market to raise funds in the 2 to 3 year maturity period, and this could be very high in the next, and this could give you good opportunities to invest in good issuers at very reasonable levels of yields. So try to take advantage of this, and then since your reinvestment risk is still low, and when the bonds come closer to maturity or come for maturity, you're sure you're able to invest at a better yield and return, or with more, or even go up the duration and invest in longer maturity bonds for both good returns as well as capital gains. Thank you very much for listening in. Do not forget to download our app, Quick Invest Buy INR Bonds, for the best curated list of bonds on offer. And if you're a financial advisor, your best place for you is for fixed income and bonds is INR Bonds Partner Portal. See the best bonds, most information, and full support from INR Bonds with its data, analytics, and proprietary risk models, and also full investment support for the best investment for your clients. Log into INR Bonds and sign up as partner.
As a financial advisor, my biggest responsibility is to help my clients make the right investment choices. Now, with INR Bonds, buying and investing in bonds for my clients is quick and easy. With my guidance on bonds, my clients are happy and I'm getting new business every day. Register as a financial advisor on inrbonds.com to help your clients invest and save better through bonds.